So there's a number on most commercial property policies that is almost never correct. And when it's wrong, the building owner usually finds out at the worst possible moment, which is at claim time. So I'm Court McCutcheon with Texas Select Insurance Group in San Angelo. The number is what your building is insured for. And today I'll show you exactly how it's supposed to work. We'll separate the three values people confuse: replacement cost, actual cash value, and market value. Walk through the co-insurance penalty with a plain numeric example and cover the pieces that protect a commercial building the right way. The three values people confuse and why what you paid does not matter. When a business owner insures a commercial building, they're often thinking about one of three numbers: what they paid for the property, what it would sell for today, or what it would cost to rebuild it from scratch. Those three numbers sound similar. They're actually very different, and only one of them belongs in your insurance policy. Let me explain each one. What you paid for the building, the purchase price, is a real estate transaction. It reflects what the market said the property was worth at the time you bought it. It includes the land, it reflects local supply and demand, the location, the condition of the building at the time, and whatever a willing buyer and a willing seller agree to transact. That number has almost nothing to do with what it costs to rebuild the structure if it's damaged or destroyed. Market value, on the other hand, is what you could sell the property for today. Again, that includes the land. That reflects current real estate conditions, comparable sales, and buyer demand. Market value goes up and down with the economy, with the neighborhood, with interest rates. It is nothing to do with an insurance number. Replacement cost is the number that actually belongs in your commercial property policy. Replacement cost is what it would cost right now, using current labor rates, current material prices, to rebuild your building to its current conditions. Same size, same construction type, same quality of finishes. No land, just the structure. This is the number your insurance is designed to protect. Here in West Texas, those three numbers can look very different. A commercial building on a main corridor here in San Angelo might have a market value driven heavily by location. The replacement cost, what a contractor would actually charge to put the walls, roof, and systems back together, is driven by square footage, construction type, and current construction costs. Since construction costs have risen significantly over the past several years, a building that was properly insured a few years ago may be significantly underinsured today if the coverage limit hasn't been updated with the agent. So this is where the problem starts, and it gets worse when we add the co-insurance clause. The co-insurance clause, explained in plain English. Co-insurance clause is probably the single most misunderstood provision in commercial property insurance. It's also one of the most consequential. Here's the basic idea. Most commercial property policies require you to insure your building for at least a minimum percentage of its actual replacement cost. The cost percentage is called the co-insurance requirement, and it's typically 80%, sometimes 90%, and in some policies 100%. This requirement exists because the insurance is priced based on the assumption that you're carrying adequate coverage. If everyone underinsured their buildings by 50%, the math that underlies the entire system breaks down completely. So the policy includes a clause that says, hey, if you don't carry at least the required percentage of your building's replacement cost as your coverage limit and a loss occurs, your payout will be reduced in the proportion to how far you fell short of that number. Let me walk you through a specific number so this can be concrete with you. So you own a commercial building in San Angelo. Maybe it's a shop, maybe a small warehouse, an office building, doesn't matter. Let's say the true replacement cost of that building today is $1 million. Your policy has an 80% co-insurance requirement, which means you're supposed to carry at least $800,000 in coverage. Now suppose when you set this up, you put the coverage limit at $600,000. You thought that was a reasonable number. The building's paid off, you've had it for a while, that's what felt right. Nobody told you that there was a formula that needed to be met. We see this all the time, folks. A storm comes through, you have a covered loss. Say the damage is $200,000, which is serious but partial loss, not a total loss. Here's what the co-insurance clause does. The insurance company looks at it, how much coverage you actually carried, $600,000. and it divides it by how much you were supposed to carry, $800,000. That gives you a 70.75 or 75% ratio. That ratio is applied to your claim. So instead of receiving the full $200,000 repair cost minus your deductible, you receive 75% of it. That's $150,000 before your deductible. The remaining $50,000 is on you because the coinsurance clause treats the difference as if you self-insured that portion. You paid premiums, you had a covered loss, and you had a $50,000 gap because your building was underinsured at the time of the claim. That outcome surprises a lot of people, and understandably so. Key thing to understand is that this is not a penalty in the punitive sense. It's how the math works when the coverage limit doesn't match the actual value. The system assumes you agreed to insure to value, and if you didn't, the claim settlement reflects the ratio of what you carried to what you should have carried. The fix is straightforward in concept. Make sure your coverage limit actually reflects what it would actually cost to rebuild your building today. Okay, replacement cost versus actual cash value and how depreciation enters the picture. Now let's talk about how the loss is actually calculated once a claim is triggered, because this is where replacement cost versus actual cash value becomes important. Replacement cost coverage, which we've been talking about, means the insurance company pays what it actually costs to repair or rebuild the property at current prices without deducting for the fact that your building was 20 years old or your roof had some age on it. Actual cash value, often abbreviated as ACV, is replacement cost minus depreciation. The insurance company takes into account the age and condition of the damaged property and reduces the payout accordingly. A 15-year-old roof gets depreciated. A building with older mechanical systems gets depreciated. You receive what the property was worth in its current condition, not what it cost to put it back to new. Actual cash value coverage is less expensive. So if budget is a real constraint, it's a legitimate option for some operations. We have people that choose that. But the gap between actual cash value, ACV, and what it actually costs to rebuild can be significant, especially on older structures. And you should go into that choice with clear eyes about what it means at claim time. There's never a problem till there's a problem. And that's what we hear all the time. But at claim time, there's a problem. Most commercial property policies for owner-occupied buildings are written on a replacement cost basis, which is generally the right approach. The critical thing is to make sure the limit of insurance actually reflects current replacement costs, because even if a replacement cost policy can leave you with a shortfall if the limit is set too low, the coinsurance clause triggers. So let's talk about now agreed value and how it handles the coinsurance problem. There's an alternative to navigating coinsurance formula at every renewal, and it's called agreed value coverage. Agreed value is an endorsement that suspends the coinsurance clause. Instead of the insurance company applying a coinsurance formula at the claim time, you and the insurer agree ahead of time on the insured value of the building, and that value is what governs the claim. If a total loss occurs, the policy pays the agreed value. If a partial loss occurs, it pays the repair cost without a coinsurance penalty. The requirement for agreed value is that you submit a statement of values to your insurer before the policy goes into effect. A statement of values is a formal document that describes your insured property and assigns a value to it. The insurer then reviews it, and if they accept it, they agree that the stated value is adequate. From that point, the coinsurance clause is suspended by the policy period. It's a cleaner approach for many commercial property owners because it removes the coinsurance calculation from the equation. However, the agreed value endorsement has an expiration date. It's typically tied to the policy term. So when the policy renews, if you don't submit a statement of value and get the endorsement renewed, the coinsurance clause quietly comes back. This is one of those renewal conversations worth having every year with your agent. Okay, inflation guard and keeping your current coverage. Even if your building was correctly valued and correctly insured when the policy was set up, construction costs don't sit still. Labor costs, material prices, and building supply chains all move over time, sometimes significantly. An inflation guard endorsement is an automatic mechanism that increases your coverage limit by a set percentage each year to help keep pace with rising construction costs. Typical inflation guard rates are in the 2 to 4% annually. The endorsement doesn't require you to do anything year to year. It simply increases the limit on a predetermined schedule. The honest caveat is that inflation guard rates don't always match actual construction cost inflation. In periods when construction costs rise sharply, a 2 or 3% annual adjustment might not be sufficient to close the gap. The endorsement is a useful tool, but it's not a substitute for periodically doing a real replacement cost appraisal or having a genuine conversation with your agent about whether your current limit still reflects what it would cost to rebuild your building. Your agent can run those numbers for you each year. A good rule of thumb is to revisit your commercial property limits when you make significant improvements to the building, whenever you hear from contractors that costs in your area have changed significantly, and at a minimum every couple years, even if nothing has changed on the surface. Let's cover 3 more components of a commercial property policy that work alongside your building coverage. Business personal property, or BPP. Your building coverage applies to the structure itself, the walls, the roof, floors, and fixed systems. The contents of your building, your furniture, equipment, inventory, tools, computers, and fixtures that aren't permanently attached are covered separately under a business personal property coverage. This is sometimes overlooked, especially by tenants who assume the building owner's policy covers everything inside. For a retail business, a service business, or an operation with significant equipment or inventory, business personal property is a meaningful coverage line. Make sure the limit reflects what you actually have inside the building, not a placeholder number that was set years ago when you first opened. Ordinance or law coverage, this one comes up after a loss, and it surprises people if it isn't there. When a building is damaged and needs to be repaired or rebuilt, local building codes may require that the building meet current standards. Even if the original building was built decades ago, a century ago, and was grandfathered under old requirements, that can mean a new electrical system, updated plumbing, additional fire suppression, accessibility requirements under current ADA standards, or other mandated improvements. Commercial property coverage pays to rebuild what was there. It doesn't automatically pay for the additional cost of meeting current code requirements. Ordinance or law coverage fills that gap. There are typically 3 components to ordinance or law coverage. The first covers the loss in value of the undamaged portion of the building when the whole structure has to come down because local code doesn't allow you to repair a building that's more than a certain percentage damaged. The second coverage covers the demolition cost of removing that undamaged portion. The third covers the increased cost of construction to meet current code when rebuilding. For an older commercial building, we have a lot of those here in West Texas, ordinance or law coverage is worth a specific conversation. The cost to bring a building up to current code after a major loss could be substantial, and standard property coverage doesn't automatically pay for it. So let's talk about business interruption. This connects directly to your commercial property policy. When a covered event damages your building and forces you to stop operating or reduces your ability to operate, business interruption coverage, also called business income coverage, is designed to replace the revenue you would have earned during the period your business is shut down or impaired. Business interruption coverage typically kicks in after a waiting period, often 24 to 72 hours after the covered loss, and it continues through what the policy calls the period of restoration, which is the time reasonably needed to repair or rebuild the damaged property. What it covers varies by policy, but it commonly includes lost net income, ongoing payroll, rent, or mortgage payments, and certain other fixed operating expenses. You'd still owe even if the doors were closed. So business interruption is triggered by a covered property loss. It doesn't work without an underlying property claim. The limit and the period of coverage both matter. We always say one coverage triggers the next coverage. So for businesses with complex operations or high fixed expenses, it's worth thinking through realistically how long it would take to rebuild and be fully operational after a major loss, and making sure the business interruption limit and duration reflect that scenario. How to arrive at a correct building value. So how do you actually know what your building should be insured for? There are a few approaches and they range from rough to rigorous. The roughest approach is using a per square foot construction cost estimate. Insurance carriers often use data from services that track construction costs by region, building type, and construction class. A simple square footage based estimate gives you a ballpark. For a standard wood frame commercial building in West Texas, that number might be in one range. For a metal building with minimum finish, it's different. For a masonry building with updated system, it's yet again different. A more reliable approach is a formal replacement cost appraisal conducted by a qualified appraiser. This is an actual assessment of what the building would cost to rebuild today, taking into account the specific construction type, quality of materials, current labor rates in your area, and any special features of the structure. For significant commercial properties, this is the most accurate method. For most small to mid-sized commercial buildings, a thorough conversation with your agent that walks through the building size, construction type, age, condition, and recent improvements will help you arrive at a defensible and very reasonable, accurate replacement cost estimate. That estimate should be reviewed and updated regularly, not just set once and left alone. The goal is to get your policy limit as close to actual current replacement cost as possible, meet your coinsurance requirement, and avoid arriving at a claim time with a gap you didn't know was there. The price you paid for a commercial building is a real estate number. The market value is a real estate number. Neither one tells you what it costs to rebuild. Replacement cost is the right number for your insurance policy, and it needs to reflect what construction actually costs today, not 5 years ago. Actual cash value policies factor in depreciation and pay less at claim time. Replacement cost policies pay the current cost to rebuild without depreciation, but only up to the policy limit. The coinsurance clause requires you to carry coverage equal to a minimum percentage of your building's replacement cost, typically 80%. If your limit is below that threshold and a loss occurs, your claim payout is reduced in proportion to how underinsured you were. That reduction applies even on a partial loss. Agreed value is an endorsement that suspends the coinsurance clause by establishing an agreed insured value at the start of the policy period. It requires a statement of values and needs to be renewed. Inflation Guard is an automatic annual increase in your coverage limit to help keep pace with rising construction costs, but it isn't a substitute for a periodic reevaluation. Business personal property covers the contents of your building. Ordinance or law coverage handles the additional cost of rebuilding to current code requirements. Business interruption replaces lost income during the period your business is shut down after a covered property loss. The most important practical takeaway is this. Look at your commercial property coverage limit. Find out what your building's current replacement cost actually is. You can work with your agent on that or work with us. And make sure those two numbers are in the right relationship with each other. If they're not, it's an easy conversation to fix. If they're not and a loss happens, it's much harder. So I'm Court McCutcheon, and I've been working in commercial property insurance for 20 years plus. If you own a commercial building in West Texas and you'd like a straightforward review of how your property is currently set up, we'd be glad to walk through it with you.